Okay, so the latest jobs report just dropped, and whoa, it sent a real shockwave through the economy. So today, we're going to unpack what's really going on, how the Fed is looking at this, and most importantly, what all of this means for you.
So this is the number that really got everyone's attention. I mean, after a pretty strong start to the year, right? The Bureau of Labor Statistics comes out and says that in February, the U.S. labor market didn't just, slow down. It actually lost 92,000 jobs. That was a completely unexpected headline, and yeah, pretty jarring.
So a number like that, it just immediately raises this huge question, right? And it's one that affects literally everyone, from Wall Street all the way down to Main Street. Is the job market, the very bedrock of our economy, is it actually in trouble? All right, to even begin to answer that, we've got to look closer at the data. So let's dive in and break down this pretty shocking report. And it wasn't just about that 92,000 job loss. The unemployment rate, it also ticked up to 4.4%. And on top of that, remember that really strong report from January? Well, they revised it slightly downward. So, yeah, it's kind of a trio of not so great news. But, and this is a big but, here's where the story starts to get a little more complicated. You've got experts coming out and urging a ton of caution, and for good reason. Because, as we know, one single month of data, it just rarely tells the whole story. And yeah, this comparison just perfectly illustrates the economic whiplash we've all been feeling. Think about it. We went from this stronger-than-expected job growth and a real sense of optimism in January, straight into this surprising loss and a whole lot of uncertainty in February. It's no wonder economists are calling it a really volatile start to the year.
And that really is the key message you're hearing from a lot of economists right now. Jake Krimmel over at Realtor.com, he puts it perfectly. He says, look, overall, the first 2 months of the year suggest we shouldn't overreact to either January's highs or this February's lows. Basically, we have one really high data point and one really low one. So the smart move? Don't get carried away by either extreme.
And that sentiment, it's being echoed right from the top. I mean, when you have someone like San Francisco Fed President Mary Daly saying, and I quote, "I also don't think you should make more of it than 1 month of data," well, that's a pretty clear signal that the central bank is focused on the much, much bigger picture. So, okay, this all leads us to maybe the most critical piece of this entire puzzle. What is the Federal Reserve going to do next? Because believe me, what they do or what they don't do, it matters a lot.
And here's the interesting thing. The consensus from economists is that despite all this bad news on jobs, this report probably isn't going to cause a big panic at the Fed. In fact, it might do the exact opposite. It likely just reinforces their current decision to hit pause and just wait for more information.
Right, so to really get what this pause is all about, we need a little context. If you remember, the Fed was actively cutting interest rates late last year to try and stimulate the economy. But then, as the new year started, they pretty much signaled, okay, we're done for now. So all eyes are on their next big meeting to see if this week's jobs report changes their minds. And the consensus right now? Yeah, probably not.
And this really gets to the core of their philosophy right now. It's all about patience. As Sam Williamson from First American puts it, the balance of risks remains tilted toward patience rather than urgency. Basically, the Fed seems to believe that the risk of acting too soon is way bigger than the risk of just waiting. So patience, not urgency. That's the name of the game for them.
Okay, so this brings us to the real heart of the matter, doesn't it? If losing 92,000 jobs isn't enough to make the Fed act with any urgency, then what on earth are they focused on?
I mean, what is the Fed's #1 concern? What's the one thing that's overshadowing everything else for them right now?
One word: inflation. See, the Federal Reserve has what's called a dual mandate. Congress tells them keep prices stable and keep employment as high as possible. And usually, they try to balance both. But right now, that scale is tipped heavily toward fighting inflation. So every single piece of data, including this jobs report, is being viewed through that one very specific lens.
And honestly, they have some pretty good reasons to be so focused on it. You've got all these new pressures kind of bubbling up, oil prices are rising, there's a ton of economic uncertainty from the war in Iran, and the core inflation rate is still stubbornly above the Fed's target level. And these aren't just abstract numbers on a spreadsheet. This stuff translates to higher costs for you at the gas pump and in the grocery store, which is exactly what the Fed is trying to stop.
And all of this leads to the nightmare scenario that keeps economists up at night. Lawrence Yun, who's the chief economist over at the National Association of Realtors, he puts his finger on the big, scary risk on the horizon. He says, the big question will be whether the economy enters a period of stagflation.
So, what in the world is stagflation? Well, it's pretty much the worst of both worlds. You get slow economic growth and higher unemployment, that's the stagnation part, happening at the same time as rising prices, that's the inflation part. It's a brutal policy trap for a central bank. If they raise rates to fight inflation, they could crush the economy. But if they lower rates to boost jobs, inflation could spiral totally out of control. There are no easy moves, and that's exactly why they fear it so much.
Okay, so let's bring all this high-level economic talk right back down to earth. What does this actually mean for you, for your wallet? Especially if you're maybe thinking about buying a home sometime soon.
All right, here's the bottom line. As long as the Fed's main focus is on inflation, the outlook for mortgage rates getting much lower appears pretty limited. The Fed's patience on interest rates basically means that homebuyers are going to need to be patient too.
But that same economist, Jake Krimmel, he offers some really good advice here. He says, don't scoreboard watch the mortgage rates. Don't get caught up in the volatile week-to-week ups and downs. Instead, look at the year-over-year trend. And from that bigger perspective, rates are actually significantly lower than they were a year ago. So that does offer a little bit of comfort.
Okay, so let's sum up the key takeaways here. First, don't overreact to 1 month's jobs report. It's just one piece of the puzzle. Second, remember that the Fed's main focus is still inflation, not jobs. They're playing the long game. Third, you should probably expect this patience from the Fed to continue. And finally, what does that all mean? Well, it means mortgage rates will likely hold steady right around where they are, at least for now.
And that leaves us with the one big, lingering question, doesn't it? With so much uncertainty, you've got a shaky job market on one side and stubborn inflation on the other. Is patience really the right move for the economy? Or is it a huge gamble that could end up backfiring? Well, that's the question that everyone is going to be watching very, very closely.